welcome all to this episode of Freedom Hub's Working Group. I'm your host today, Jeff Cantor, along with my co-host, Charles Roman. We have some fantastic sponsors that we're engaged with, as we'll discuss. Also, we are the intervention point for activists and entrepreneurs that are trying to disrupt this world, and we're going to work real hard to make it a lot better. We are, as you know, recording these for posterity. These are the links that they're at, but we also have a special website that we showed before that you'll get to see in a minute here, where they're actually housed as well. One of our other key sponsors is the Heaven Sent Hemp organization. We're always on the prowl for some of the top stuff in any category, and we found it here in the hemp world. This is what we've discovered to be, as we can tell, the most only bioactive product there is, which means that you can tell it works the minute that you put it on yourself. And we were able to work out a special pricing point with them. Instead of like 5 or maybe 10, but you actually get 15% off if you go to their site and use this code. And there's the site link. I'll show you that in a minute. And let's take a peek. Now, we also operate a LinkedIn group that you might want to participate in. It's always quite entertaining. And as I said, we have a special new website that's a part of this whole process. It's This and Beyond. This is the main page, but let's take a quick tour. And if I'm not mistaken, and I want to double check before I pursue this, but I think I have Jane on the line here, who's the managing director. And I'd like her to be able to comment a little bit too as I go. Are you there, Jane?
I am.
Okay, great. Because I'm going to mention a couple things, but I'm going to let you elaborate since you're really kind of more involved in fleshing this further. But there's a variety of drop downs within all these various areas, and we're adding them constantly. And if you're interested in participating or helping develop content or knows others you think would be valuable here, please, we encourage you to follow up with us. This is like a simple example, some of the different pages that are all going to be expanded, but this is the beginnings of a lot of this stuff. These are organizations you may not be aware of all of them. Some of them you probably are, but this will be some videos and other interesting information you're going to be cognizant of. We certainly have some breaking news on a variety of topics, action items, and things you're going to want to do. We're going to expand on that part of it pretty dramatically, and as well as other videos and stuff from the past that you'll want to take advantage of. Also some good news for a change. So we're breaking a particular one here on the We Do Better organization and the healthy card and so on, but there'll be more as we go along. We're actually going to feature the marketplace. So you'll notice that the hemp program we talked about was listed in here as well. And the fellow's going to speak tonight is going to be on there as well. And then also where we talk about this call that we're on today. So that's why I'm kind of leading this long road to this page. But here's where we talk about who's going on. So here's our call today on the left, and then here's forthcoming, and then there's other links to those various websites. So if you didn't mark those down or remember them, all you have to do is be able to come here. And then when today is over, we're going to actually continue that conversation with these people that we have as guests, and we're going to talk further about different things that they've got going on and be able to communicate back and forth. So it gives this stuff a longer shelf life. Jane, what did I neglect to mention?
I was just going to say, I think you did a fantastic job covering all the basics there. That's fantastic. Thank you.
Oh, darn, I should have said a lot less. I wanted someone to hear you talk a little bit instead of just me all the time. Why don't you tell them what's going to be coming up? What are you adding to this site?
So behind the scenes, one of the aspects is a page for our speaker today with Rich Keal is FreeBridge and all his products. So I've been working on that. I'm just going to connect with him to make sure everything looks visually the way he wants it. But that's going to be an exciting aspect of the website as well.
Okay, super. All right, so we've got that. Our other sponsor is Your Freedom Hub. This is where he kind of works in conjunction a little bit. There'll be some products and services here depending on your thing. This happens to be that Heaven Sent Hemp site, so you'll explore. And then just as I said, we do archive all of these, and here's a variety of channels that we're on, Brighteon, BitChute, and YouTube on all of these. So you'll certainly want to come and visit whichever one you prefer and subscribe for sure. And so that's kind of the setup on where we're at so far, but let's talk a little bit about who's talking today. So I'm going to let Charles take over the introduction right here, and let's use this as our demonstration piece on the left. Go ahead, Charles.
Thank you, Jeff, and welcome, Rich and Brian. As Jeff and I have disrupted mainly healthcare with our Forbes featured cash patient making plan, we've also wanted to branch out into wealth, not just your health. So we've been looking for disruptors in wealth. And Jeff can probably expand on what I'll say here, given his background in financial advice and planning. But Brian and Rich are looking for ways to protect assets, especially now with the COVID aggravated recession that was caused long-term more by the Federal Reserve excessive money printing. But people are scared with their investments in the stock market, with their 401ks and mutual funds. And some of us have heard about alternative investing based on insurance and other financial products. That's sort of the area that Rich and Brian are going to introduce for this show today. We want to protect assets. We want to be smart about it. And apparently their alternative is a strategy that bigger institutions have been using for years. And it's just not something that your regular middle-class investor knows about. So that's about what I know. Jeff, if you want to add to that.
I'd say that's quite good. I mean, the only thing I would add to that, and they'll obviously explain the whole thing themselves, but typically anybody that's on TV or whatever is telling you something to either invest in or that you should do this or whatever, it's typically, it's not that it's a bad thing per se, but it's not the best thing by any stretch, because there's too much profits built in or whatever else. And then in most instances, you're not in control. So you don't even really know what's going on half the time. So we're going to really get the chance to get our eyes and ears opened here today. So that's fantastic. And thanks, Charles. All right, I'm going to stop sharing and I'm going to switch the service back over to you, Brian, so you can go ahead and feel free to grab the screen. You're good to go.
Well, since I'm the senior partner, I'd like to lead off and talk about my life up until I met Brian 11 years ago.
Perfect.
If you're okay with that.
Oh, that'd be fantastic. Let's set the context, because that's part of it too. How did you get to that discovery to be where you are? You were like all the rest of us, just plowing along like every other schlub. How'd you turn it around?
Well, sometimes your curses are your biggest benefits, and I came into the industry 35 years ago next month, and I never had the I never ended up at a bank, brokerage firm, an insurance company directly. I was always in a brokerage capacity. So I never had to sell the soup du jour, right? And so in my path, I was always seeking for new opportunities and discoveries, and I was willing to be wrong, always willing to be wrong to have it right. And about 97, I ended up meeting a guy by the name of Bob Castellone, and he had created a financial system called the LEAP system, which stood for Let Each Agent Produce, or Lifetime Economic Acceleration Program. And so he was extolling the virtues of velocity of money. So, here's how banks make money and rotate money. And so he was showing you how to go high reward, lower risk. And that was never even introduced to me before. The whole concept of how do you get high reward, low risk? It was always the latter or the other that was an option: high risk, high reward. And then, a few years later, the gentleman who created the software for him, he was good friends with a man by the name of Nelson Nash. And Nelson had written the book called Becoming Your Own Banker. And I learned real quickly he was friends with Ron Paul. And so I ended up down the rabbit trail of the Federal Reserve and how evil it is to print money and debase money. And so along the way, I also met some people that were really, really big insiders in London, and they were doing prop trading for the banks. And my mind was completely blown. I had met a lawyer in New York who was teaching me how to do non-recourse stock loans. And when I would tell people about it, those two words didn't even belong in the same sentence. They didn't even register. Non-recourse loans? What are you talking about? So for me, it begged the question, why, if the average investor is not allowed to do that, which I discovered through my process of trying to get it through my broker dealer at the time, before I started my own registered investment advisory firm. I realized that, they're just protecting the house. They're not protecting the individual, because once you understand banking and you understand how banking integrates with the investment world and the insurance world, you're really at the root of the problem, or you're at the root of the opportunity, the other side of it. And 11 years ago, I met Brian, who's a genius at financial modeling and spreadsheeting and you name it. It's just, the guy can do anything and does anything. He's a partner in Home Wealth IQ. He's built a lot of financial models for various institutions in financial services, more on the insurance side. But anyway, that led us to where we are now with the whole idea that we're calling structural integration, or how do you seek and create structural alpha? Well, you do that by mirroring what family offices do for their high net worth people. And when you start looking at that, you get an eye opener. And we're just really excited to be able to be doing what we're doing right now. Because, well, I am, because I wouldn't be able to do it without Brian and his ability to demonstrate all these moving parts at once and prove it to people. So it's pretty much irrefutable. So I'll let you take it over from there, Brian. But the components of the financial industry, insurance, banking, and investments, they need to be taken all into context holistically. And so I'll let Brian take it over.
All right, hi. So yeah, that's a great intro, Rich. And I would like to kind of speak to what has been driving me and my driving force anyways, and my mission in financial services. And I came into this business in 2007. And, one of the things that has been a fairly consistent theme throughout my career has been the kind of, let's just say there's a mystification about finance for individuals, and even in the advisory community, there's a lot of information out there that I've found to be not exactly well thought out or well understood. And Richard mentioned that that I'm pretty well versed in financial modeling, and that was born out of my just insatiable desire to know that I know that I know. And so when somebody would present various financial strategies, whether we're talking about insurance or we're talking about investments, I would then, sit down, and instead of watching TV at night, I'd pop the laptop out and I would make spreadsheets, and I would, start modeling these things. And I would determine what is the underlying factor that really makes something work or not work. What is the key component? And, what you find at that point in time is that most of the world has this desire to kind of defer to experts. And so we often kind of check our brain at the door a little bit. And rightly so, because, we can't all spend our time under the hood. We wouldn't get anything done. But what I find is that there's just so much information out there that's bad information. May not be terribly detrimental, but it's just not the right information. And there's some misunderstandings. And when you have a fundamental misunderstanding of how things function in the world, you start to attribute, the wrong, I don't know, it just undermines your understanding of finance. So anyways, that getting to this, what we have on the screen here, and these, the components of the financial services industry, the reason why we have that on the screen is, because we really want to take a step back with people and help them understand, what exactly are you working against or working with as you plan for your future and you plan for your own financial stability. And, so we'd like to talk about these various components, or these three components of the financial services industry, because it's a good way for people to take stock of their relationship with each one of them. And, it's all about trying to make it simple and relatable. And if you look at each industry, and you look at the insurance industry specifically to begin with, one of the things that you can clearly say about the insurance industry for most people is that it is a net outflow. from day one. They get their auto and their, renter's insurance when they're in college or, high school or what have you. They get their homeowner's insurance when they get out. They're looking at life insurance, you name it, all the various insurances. If you're in a professional degree, maybe you're getting disability and spending a lot of money there. And the next thing you know, you've got thousands and thousands of dollars as outflow, every year, year after year, systematically increasing over time because, they pay claims, and claims, cost money in inflation adjusted dollars. So unless you have a guaranteed product, those premiums will march right along with you and increase. And so what we know is that over time, people will spend hundreds of thousands of dollars in insurance over their life. And, the only way that they actually receive any benefit out of that typically is in the event of a claim. So it's kind of leaves a bad taste in people's mouths. And so they'll say things like, insurance poor and I never really got anything out of my auto policy because I'm a good driver and I haven't had any bad luck with bad drivers. And so anyways, that's kind of how people, view it. And so what we're trying to help people understand is when you're looking at these industries, if you're looking at them from the lens of a, kind of a retail customer or a consumer, you're kind of missing the better aspects of it. Because one of the other things that you can know about this industry without digging in too deep is that it's very profitable. It's a very profitable industry. And as evidenced by all the commercial buildings that are around the country and all these metropolitan areas, lots of them have insurance company names on them. And there's a reason for that. And so the question is, how do you take what is generally an outflow to the insurance industry, which is helping to generate those profits and in excess of the claims that they have to pay out, and how can you flip that around to where it's a net benefit to you? How can I kind of dance with this insurance industry and figure out a way to where I can turn that net, from a net expense to a net income? And there's a very effective way to do it. There's a way to do it that corporations understand. There's a way to do it that these, like Rich was mentioning, family offices, they understand it well. And it's a very effective tool. And so, we'll get into, the specifics here in a minute, but I want to kind of march our way through these various, sectors. Especially, when we think about the banking industry, it's not the cost of insurance now it's the cost of interest. And again, the same rules apply. We know it's a profitable industry. And we know that people are in general serving that beast of a debt that they're carrying throughout their life. They may pay off their mortgage, but then they got to go refinance for one reason or another, and they end up back in debt. They're buying cars, they're paying off student loans and what have you. And one thing that we can, say for certain about it is that the vast majority of people on the net are paying interest into the industry. And so how do we address that? I mean, how can we change that flow of interest and get on the right side of that transaction? Okay, and that's really the game to be played here, because it's not that you're paying interest that's the problem. It's that you're not earning interest, and you're not earning interest in a guaranteed manner. And so that feeds into the investment side as well. And we don't have to dig too deeply there, but let's just say, we'll do a little slide later on in the presentation and talk about, kind of the costs inherent to investing and the risk and all that. And you'll see that it's very hard for people. There's a lot of headwinds when people are investing, and many times people will say, it's kind of like in business, right? People will talk about how much they earned, and they'll say, oh, I did $1.5 million last year. And it's like, okay, so now tell me, how much did you net? And that's always a different number. And it's very much the same way with investments. So anyways, we can kind of move along here. I gave a couple of examples here because I wanted to blow up a few islands if I could. But before I go into that, maybe Rich, you want to step in and say something? You don't have to.
About banking, for example. You mean
Oh,
about
no,
banking?
no. I'm just before I jump into a next slide here, I just was wondering if you.
Oh, I did want to say that I forgot to give you an accolade.
What's that?
When we started working together from that phone call I had with you in Honolulu when I was out there working with people. Brian started working with all of my clients at that point because he had shown me something that was dramatically, well, I shouldn't necessarily say dramatically wrong, but it was enough of a tweak that I needed to know relative to cost of money. And so we were able to go back to all of my clients over the years and be wrong to have it right. And we retained everybody, and it wasn't a good, bad, it was much more like better, best, but it's been a wonderful transition, a big Jerry Maguire moment. So anyway, go ahead.
Yeah. And so, overall with what we're looking at here, it's really, about, one of the things, I haven't watched all the videos that you guys have done and some of the conversations that you've had, but one of the things that most people deal with is they have a lack of control in their lives. They have a lack of certainty, and they have a lack of options. And if you look at traditional, financial planning, which is wrong, like within a week after you put the plan together, because things change constantly. The idea, from this, you really want to help people understand that they've got their eye on the wrong ball, and you want to help them understand that it's really like optionality that makes the difference for people. I've got hundreds of anecdotes and client stories and things of that nature where it never had to do with the average return in the market in their portfolio in their 401k. It had to do with a situation where they had to make a decision, and there was catch-22s involved and all sorts of things. And because of the way that we operate and what we set clients up for, we provide them with the optionality that they need. And realistically, it's that, if you look at how the system steers you, it steers you into a way where, the insurance industry and the banking industry and the investment industry, their objective is to control your money, right? And they get you looking at, these things in a way that is, you're actually looking at it and saying, well, the person that's trying to do it differently, they're the dumb ones. They're making you feel stupid for playing the game a different way. The way that it's, you feel like you're part of the crowd is the way that they maintain the greatest control. And, how is that, right? Well, they just keep me as a perpetual customer. I'm the one that's taking the vast majority of the risk, or I'm the one that's sharing most of the income for them, or what have you. And anyway, so it's just about kind of tweaking your brain and saying, I need to switch from this role where I look at these industries and just say it's a place to go buy, products or investments and whatnot. And I really think about it more strategically. So with that, let's move to an example here, because this is just a simple one. And I never fail to have this conversation. Well, and it's not initiated by me necessarily. It's just that people bring it up all the time. They bring it up about their cars. They bring it up about their homes. They bring this conversation up regarding commercial mortgages. It's the same thing. And so the question is always, if you're looking at, your cash flow as an individual, or you're looking at your cash flow as a business, what do you do with your surplus cash flow? All right. And assuming you have surplus, we hope you do. And so with that surplus cash flow, it's got to find a place. It's got to find a home. And that home is on the balance sheet. And the balance sheet has two sides. It has, the liability side, it has the asset side. And so we each have to make a decision, every time we have that surplus and it starts accumulating in something like our checking account, we start to say, we've got this cash. What are we going to do with it? Are we going to go make an investment, or are we going to go and pay off some debt? And so here I give this example. And the reason why I like to give this example is because, you have to think back that when I started in this industry, it was 2007. There's a lot of mortgage acceleration programs, debt payoff programs. We still have Dave Ramsey, Susie Orman, and all the like out there promoting paying off your debt as fast as possible. And so anyways, this is always helpful because it tweaks people's brains a bit. You'll see here, I won't give you all the dirty details on it, but the bottom line is we have a mortgage, and you'll see here the yellow, it's called a non-financial asset. Okay, that's because home equity itself is a non-financial asset, and you'll see the red is the liability here. And let me get a little annotation here so you can follow my mouse. There we go, that's better. And so this person decided, you know what, I'm going to go ahead and I'm going to pay 100% of that surplus to my debt. What ends up happening? Well, in about 13 years, I see, you know, I'm successful in eliminating that 30-year mortgage that I had. And at that time, I switched from eliminating debt or reducing the liability side to increasing the asset side over here. Okay. Now with this blue line, you'll see I write liquidity. So I'm just talking about marketable securities, liquid assets. Okay. And over, you know, at that time, you'll see that now we can start to contribute and accumulate wealth outside of our home in financial assets. And you'll see that over time we get up here, and at the end of 30 years, we have a paid off mortgage at year 13. And by year 30, we have $561,000. And this is, you know, just some basic assumptions that people are familiar with, you know, like 8%, you know, long-term in their portfolio, 4% mortgage, and that kind of thing.
Looks like you murdered the thing you can't get back.
What's that?
Time.
Oh, yeah. Well, let's see, you know, and we can't take a poll right now to see where people stand on this, but I think people are going to be surprised to see just how dramatically different a shift, you know, when you look at, you know, I'm going to go this left or am I going to go right? How significant can it be? So you'll see here, I put in there 275% increase in financial assets, right?
By doing what?
Oh, I'm getting there.
Sorry.
So instead of increasing, you know, or decreasing the liability side, and we can play this game. I have a little slider bar in this calculator where I show, you know, do you want to go 100% to debt, 100% to assets, or somewhere in between? What are you most comfortable with? Okay. And when we direct it to 100% to increasing assets, what do we end up with? You know, this is just a apples to apples comparison to show what, you know, what we're looking at in comparison between two strategies. And what you find is that, well, look, you know, I'm here at year 13 right here, and I have something like in the neighborhood of $350,000 of financial assets. Now, if you run into any kind of financial difficulty, you know, you lose your job, the economy, you know, is drawing down, or the market's drawing down, and just any number of situations that people run into. And we saw tons of them in the last financial crisis. And when people don't have options, when they have their money tied up in liquid assets or a non-financial asset, you know, what did they find out? They found out that the Bank of Hawaii is freezing their home equity line, and any number of things, any number of barriers of access to their wealth, not to mention the fact that their housing value had just dropped off substantially. And this happened for individuals in their personal residences. This happened for investors that were doing new build with 15, 20, 30 units. We saw it repeatedly. We have many examples of people that struggled, and I'm sure many people, you know, that watch this have all got some stories to tell about people that really got burned by not having options. And so this person here is sitting with 350 or so, but let's just go to year 15, $487,000 accessible, usable money. What do we got? Year 15, 20 versus 487. Okay. So the whole point here is that at every point in time, when we look at this chart, we have, you know, greater access to capital, greater optionality, and ultimately 275% increase in the ultimate outcome in terms of financial assets. We both own the home, but not both of us are, you know, seeing.
Hey, Brian.
Yes.
But remember the conversation about where. this conversation about where do you put the money, and that's kind of the fly in the ointment, or the grist for the
Right.
mill.
Absolutely. Yeah. I mean, one of the problems is, and you might just jump right into that. If we had the same scenario and you were an investor in a Robinhood account with a no-fee broad market ETF, you might have saw a 45 or 50% decline in your portfolio. So we're not looking at 487, maybe we're looking at 240, right? And so the question then becomes, if I'm going to build up assets and I'm going to build them up in the context of not paying off a debt, because that debt, if I pay it off, it's a guaranteed savings and interest, right? And so to go out there and effectively, invest, and in some cases, or in many cases, gamble your money, in the way that many people approach it, is not the smartest move. I mean, so for somebody that doesn't have the, good options out there, or is not, or is just putting money into their 401k, this may not be the right strategy. You have to be very selective about the asset you choose. And so what we want to do is we want to make sure that when we're looking at assets, we're going to select the right asset. And so, the key word here is going to be cash value. Okay. And it's going to be cash value in a life insurance policy, because, that's the one asset class where you can go in and you can contribute. And once you've contributed the money, once you've seen a guaranteed interest rate applied to the growth of the policy, and once you've seen a dividend paid, it becomes part of the guarantee. So what it in fact is a non-correlated asset. Now, it's not a financial asset. We would have to call it a non-traditional asset, or an alternative, because you'd have to sit there and debate the certified financial planners and what have you,
and the RIA industry,
all the credentialed folks out there in the world about whether or not. But I'll tell you what, if I can go pull money out of it, whether that be from a loan from the carrier or using a secured line of credit against the cash value, the money spends just the same. And so, I don't really give that argument much, I don't think it holds much water. But the bottom line is that when we're looking at these numbers and we're looking at this comparison, we have to make this decision. Do we want to accumulate capital in a place that we own and control? So getting back to that whole concept of how you have your eye on the ball, or maybe the wrong ball, what you want to be doing is thinking about, what's the institutional game? The institutional game is control. Okay. And it's about risk shifting. It's about getting, in a sense, a free lunch. Okay. And how do I do that? Well, in most cases, the risk is shifted to the individual. Okay. And how these, just the games that are played by financial institutions. But if you utilize, an asset like life insurance, permanent life insurance, whole life insurance, you can, in fact, shift the risk to the financial institution, okay, in terms of the returns and the guarantees and all of that. You can accumulate capital, take advantage of the tax benefits and the asset protection that Jeff had mentioned in the beginning of the call. You can do all of these things, and you can have a very effective strategy that gives you, this non-correlated asset. Non-correlated meaning that when the market goes up and goes down, it's not affected by that. Okay, it's not moving with the market. The market goes down. This is just chugging along at its guaranteed rate, along with dividend rate that they do pay, and that part can adjust and does. But the bottom line is that when the market goes down, it doesn't. So why is that important to have? Well, for the reasons we were stating earlier. If you don't if you don't have a non-correlated asset, what are you going to have? What tool do you have in the toolbox to help you address the unpredictability of life? And so that's kind of.
Remember the 4 basic rules of financial institutions? That really woke me up back in the day when Bob Castellone said the 4 basic rules are: they want us to give them our money. They want it on a regular and ongoing basis. Hold on to it for as long as possible and give it back as little as possible. And when you start looking at those rules, when you look at those rules and you apply all of the the principles or the features of the products that were sold every day in financial services. It just plays right into their profitability model, not ours.
Absolutely. So let's move on. I'll kind of move through this other one a little quicker, just to let's get to Q&A here if we can. So if we look here, I wanted to show an example, okay, of what $100,000 could look like after 30 years. I mean, maybe your high school Algebra 2 teacher showed you something like this, how you're going to be a millionaire and so on. And so I do a simple example here, and I show $100,000. What does it grow to be at 8% over a 30-year period? It's $1 million, right? And what do you have? You have 100% control of that, or of that opportunity or the asset itself, right? And I say your cut, 100%. But that's not the whole story. We know it's not the whole story. So let's move on to the next one here. Oh, you got to pay taxes. Now I put 25% in here. I think it's fair. I mean, I know that we have short-term or long-term capital gains at 15 and 20%. And there's all sorts of nuances to it, but I think it's fair from a long-term standpoint, where long-term capital gains have been and are likely going again. So when we use that number, what you find is that out of that original $1 million here, government took a swipe at you, and not only do you lose the money that you pay in taxes, but you lose the opportunity to earn the money on those. So I still show that full amount that you could have earned, and then you'll see here that that it really takes a bite out of that $1 million. So now we're down to about 57% just with taxes. Okay, that's not the whole story though. So let's keep moving. Fees. All right, so this can be debatable and all that, but there's fees upon fees upon fees in investment management, portfolio construction, the fund managers, and so on. You may think that fees at 2%, is actually excessive, and it could very well be. Any fee in the absence of value is expensive. But it could be a good value and therefore worth it. But anyways, in my experience, and believe me, I have done a lot of research on what the fee structure is in the market, and all the points that you pay in. 2% is pretty darn close to the average for most people, and they just have no concept of the fees that they're actually paying. And the financial institutions are always fighting and finding ways to bury fees so that you don't see them. And that's just the fact of the matter. So, I mean, if you do it yourself, you can squeeze it a bit, but not a whole lot. All right. So if we look at this right here, and we get that advisor's cut in there, okay. All right, and I really should say Wall Street's cut, not advisor, because it's not just the advisor. That would be like a combination. So my apologies for the mistake in my slide here. But nevertheless, what you see here is you're relegated to about a third of that potential over that period of time. And then the last one is inflation, okay? And if I just put inflation at 2.5%, and we look at our $1 million originally, and we see where we end up after 30 years, that's $151,000, guys. Purchasing power at the end of 30 years, okay? So, when you look at investing, and this goes back to the comment that I made about a business. Whenever you talk to somebody about, how they did, they want to talk about how their business is doing. They want to talk about how they did in their portfolio. They want to talk about the winners, not the losers. They want to talk about the gross, not the net. It's the same thing here. So if you look at this, you can't evaluate strategy without incorporating all of the relevant factors, especially when they take such a substantial chunk out of your future potential. Okay. And so you'll see here that with those headwinds, I mean, the point of looking at this is that you can't just sit there and go, well, advisor A or portfolio A has a historical of 10%. So I'm going to go with them and I'm going to go chase that return. And, versus advisor B, that's only at 8.5. Okay. That is minimal, compared to the real problems that you see on the screen here that you face and will always face. So what we want to do is we want to focus on the things that we can control, that we have a decision. We can make a conscious decision to, attack those things that are really hurting our long-term, wealth creation. And that's, the fees. We can go and systematically, and Rich was mentioning the term structural integration. There are ways that you can, structure yourself to eliminate unnecessary fees, to get, let's call it cogeneration or free heat, off of having, we've been talking about life insurance. You can't go out there and do for example, a bond portfolio and get a guarantee on it like this. Okay. You can do short-term bonds, but you're not going to get the return, and you're certainly not going to get the benefit of the life insurance and the actual death benefit that goes along with it. So there's that. Taxes, what can you do there? I mean, there's all sorts of tax mitigation strategies, but again, this is about, life insurance grows tax, deferred, and ultimately comes out tax-free, as long as you do it properly. But there are, it's not just about the life insurance. There's tax mitigation strategies across the board that we have to take into consideration. So we want to focus on that, and we want to focus on how can we shift the risk? How can we reduce our risk, that we're taking unnecessarily? How can we shift it and work collaboratively with the financial institutions instead of seeing them as, and taking an antagonistic relationship? We want to run a rule with them a little bit better. Let's see here.
Yeah, I put a little story in the chat window about a case that we worked on that explains it. So
sure,
maybe you can pull that up. I mean, we don't need to read it now, but
sure. And so, yeah, we'll do that in a second. And bottom line, guys, is, when we look at, what is the best return, and this is kind of the net conversation I'm just, explaining to you, and that is, if we're looking at a 6% return on cash value, right? Is that the whole story? No. Is the 8% return on the investment portfolio the whole story? No. And with hard money lending, 12%, no, that's not the whole story either. The whole story, we got to talk about the fees. We got to talk about the taxes. We got to talk about the risk, and we got to talk about the net. Okay. And so as you see here, and I'll just, I don't need to read through every one. I just want to show people that you really got to take into consideration, all of the factors and the net. And so many people avoid doing the full analysis and explain the net. It's one of the most important factors. Now, I'll pull up this piece here, Rich, if you give me a sec.
Oh, I don't think we need to. Just give people need access to it, maybe to read it afterwards. It's that story.
I have it.
Okay.
I can even post it in the credits, as it were, but
Okay.
I'll have it open when we pop out of this section.
Okay.
All right. So
Yeah.
That's and for those people that will be watching this and thinking, just another life insurance, conversation and all that, I will grant you that life insurance has been, let's say, imperfectly marketed and implemented out there in the world. And
Horribly.
I have seen my fair share of it. So there is a right and a wrong way to do it, and there's no question. And so when you do it right, and and you squeeze it for all it's worth, and maximize the benefit to yourself, it can be a wonderful tool. If you don't, it can be a lukewarm tool, if not a slight loser. And a lot of people end up in that situation, and just because they had somebody that didn't understand the product, or they went and, well, I'm not going to name companies, but let's just say the one with with signs in every street corner in America. If they just bought their life insurance from them, they probably just got something that's off the shelf and not really geared towards what we're talking about. But
Institutional.
when you do it properly, you can do something that I've illustrated here, and we won't dive into numbers, but when you do the life insurance strategy and you kind of bring this all together, and you show somebody how you can address this whole net, the cost of insurance, the net expense in insurance, how they can address their banking issues, and how they can address their investment issues, and integrate all of those into a coordinated strategy, and you're doing these things in the context of each other, not in their own individual silos, I can show you, it's just facts, it's just numbers, that done properly, you can do this in a way that doesn't come to the detriment of your long-term wealth accumulation. So when you simply say, I want to look at the rate of return, you will never see the whole story. You will never learn, about the options that exist that give you access to, lower fee strategies, lower tax strategies, lower risk strategies, and doing them in a way, and I will explain this here, but you're never going to see that because you're always focused on the wrong objective. And so here you'll see I did an example of a 53-year-old, and I said, hey, we're going to do that standard asset allocation rule that you'll see out there, where we're going to allocate so much to equities and so much to debt securities or bonds, right? And so you see the 70-30, 60-40 portfolios that are recommended when you go get onboarded at a company, and they'll have you do your 401k selection, or in your brokerage account, you want to look at model portfolios. This is what you'll see. You'll take your risk tolerance and they'll put you in one of these things. And then over time, you'll see that this is declining. And the reason is as we get older, we're going to start shifting our allocation towards a fixed income component. But what if I'm able to take this alternative fixed here, which we're looking at as the cash value and the insurance component strategy, and instead of doing it in its without, in the absence of your portfolio strategy overall, let's do it in the context of it, and then we design the contribution to basically be wedded to your portfolio strategy and show you how we're not going to violate the asset allocation that you would want as a maximum fixed income allocation. And when you do it this way and you look at the growth in that asset and you compare it to historical growth in the fixed income portfolio and so on, you'll see that it's as good of a stand-in as you're going to get. There's lots of white papers out there that discuss this and dive into great detail about how it can be that seen and used as a proxy for fixed income. And so what we end up with is a strategy where the long-term wealth accumulation can be the same, but with lower risk and greater benefits, lower fees, and so on. So
remember when I was running around with Hannah, we were on that radio show with her in Seattle.
Yep.
And I had met a woman who did the proprietary trading for Deutsche Credit Bank in Berlin. And she had such a passion for getting everything right. She came to America and set up an advisory firm that mirrored what the bank was doing for itself in Germany. And she really wanted to democratize investing. And so she created these structural investment products, or structured investment products. Sitting here reading structural. And so I ran her around to all the advisors I knew in Seattle at the time, and she's literally showing them how to have principal protection using treasuries, and the options play that they were using was out of the city of London. And so she had the opportunity for unlimited upside returns with no risk. And I ran her around to all these advisors, and all of them were just frozen. They didn't want to accept it because she was basically doing what they could never do, and she was doing it for a fraction of the cost. Like, what was it, 90 basis points, something like that, Brian?
Mm-hmm.
And then
it was actually lower than that.
yeah. And so they couldn't justify tacking their fee on at all. And there are products in our marketplace that mirror that now. Probably not as efficient, but you can do that. And that's just an example.
Yep.
Of what's going on.
But I think that the reality is, though, that the objective of principal protection and absolute return in your portfolio and all these concepts these are terms that most people are not familiar with. They never hear from their investment advisors and whatnot. And what she was doing is the closest product that we have to that, besides what was it? Lehman Brothers did structured investment products, but that was based on their own balance sheet. And so you had counterparty risks. And so when they went down, those structured products went down. The difference with what she was doing is that it was a separately managed account. You would use treasuries as the underlying. And one of the biggest problems that advisors had with it is getting their clients to accept the idea of being charged a management fee on a product that essentially was 85% treasuries. And so that story is a very difficult one to sell, but it's interesting. What's really interesting to note is that a separately managed account, hard to sell. Okay. A structured product in an institution like Lehman that went down, not so hard to sell. Why? Because there's fees. So you just got to follow the fees in terms of the industry and why, certain things get traction and why others don't. And so, when you look at and evaluate product, or you evaluate strategy, you always want to look at how, what are the incentives? And so in our model, what we've done is we've integrated all of this so that, it is what it is. At the end of the day, we're looking to develop the lowest cost, lowest fee, lowest risk strategy across a broad set of products and inclusive of both investments and insurance products, investment and insurance products. And what you'll find, and why that's so unique, is that most people kind of stay in their lane. They stay in the camp of either investment only or insurance only, and the other is is a terrible thing, a waste of money, too much risk, you name it. They've got, they're
it's a distraction.
Yeah. So
No,
really,
it's very true. And I need to interject because we're just reaching a good breaking point here. So that's a good kind of a spot to kind of end things. And one thing the way I kind of framed it when I had been involved in the past was just kind of put it in a context, because obviously everybody's worried about what's in it for them. And so it's really, well, let me ask you a question, because you know how life functions, and if you're married or whatever, and something happens to you, then what happens and all that kind of setup. I said, but let me ask you this: what really is most important to you? If you knew that this could occur, more money for somebody when you're dead, or more money for you while you live? Which of the two is more important for you? Then we can sort of figure out how we want to have this conversation. And everybody always said, for me, while I live. I said, well, great. Then let's show about how that's going to work. And then it's easy to kind of break into what you're saying there. One thing to ask, because we got some questions here, we want to squeeze a bunch of them in. What do you think is going to happen when people in America start to get subjected to negative interest rates at the bank? And a lot of people don't even know what that is, or that's actually even occurring somewhere else in the world, the idea of a negative interest rate, because I'm already getting like 0 at the bank, my checking, or I'm getting 0.00001, kind of a thing. What's that going to mean? And especially with what you're talking about here too.
Well, I've been living that in Europe for the past so many years, 7-8 years.
Yeah, you're living in Hungary, right?
Yeah. So, I mean, the banks, it costs you money to put your money in the bank. So,
So what does that look like? If I put $10,000 in the bank, what does that mean?
You get, if you take it back out tomorrow, you might get 9,000. I mean, it's a liability. Putting money in the bank is a liability to them. And
is there an option? Can I put it in my mattress, or what am I to do?
Well, that's what a lot of people do. I mean, if they ever destroyed cash like they're talking about now, I mean, these people would, the hemorrhage would be brutal. So, I mean, we've got a lot of cash.
So they're talking about bringing negative interest rates to the United States, and how would that impact? Well, what you showed before, like I'm doing the normal routine, 401k, the whole bit, or I could do this. Is there going to even be more of a dichotomy between the two outcome-wise?
Oh yeah, absolutely. I don't know if you remember the articles, and this is going back probably like, I don't know, when did Cyprus happen?
I was thinking of that too. That was 11, 5 years ago?
12, 13. I don't remember anymore.
I don't know.
I've got too many kids in the interim to remember what year it was. So, but in that scenario, Jeff, the I actually went in and was studying what happened in Cyprus with their bail-in. And for those that had accounts, like I think it was greater than 100,000 euros or something of that effect, or maybe it was the equivalent of that much in dollars, right? But they did a bail-in, and I think the haircut they took was close to, what was it, like, it must have been like 50 or some odd percent. They took quite a haircut in their banking industry. And, so I was curious. I was like, well, geez, what happened with the insurance industry, right? I mean, because insurance companies also have, they have to work with depository institutions as well. And, they weren't perfectly protected, but it was, the haircut was very, very much smaller, right? So we're talking like mid-teens or 20 versus 50 or 60%. It was quite a bit of difference. So why is that important? Well, as part of that conversation, what else do we know about banks? A lot of the people in your audience are very familiar with the conversation about, as a depositor, what is your contractual relationship with that bank? And it's as an unsecured creditor. You're a creditor to that bank. They owe you money. I mean, you got FDIC insurance and all that, but at the end of the day, you're an unsecured creditor. The difference between having your money in that bank versus having your money with somebody like an insurance carrier is that they have a whole host of rules that are separate from them what financial institutions like a bank have. A bank can have an equity position of 3 to 1, sub 1% equity position as it relates to their overall loan portfolio that they're supporting. Whereas an insurance company has statutory reserves where they have to have enough in current assets to pay all the claims and so on. So they're much more financially stable just by design, by law, by requirement there. And so what you end up finding out though is like, look, just having a place to store your capital and have kind of a tailwind behind you at all times. And we don't have time for all the anecdotes and whatnot, but I just had a friend of mine who was talking about how he's going to go pull some money out to get liquid because he's building a property. And so he's going to go, and he had a loan against his policy. He went and refinanced his mortgage and placed the cash in the policy where he's getting roughly 4.5%, 5% year over year. And the loan is like 3% right now. And so it's free money and it's liquidity for the next 12 months while he's in this construction phase. There's little things like that normally in traditional financial planning, you wouldn't even see those options, but they're very impactful.
Yep. It's just all about understanding and knowledge. Charles, I see you've got your hand up.
Sure. And I know we're running out of time, Jeff. Let's give some quick examples, in case we have folks that are ready to move a little bit to test this out. It's new to most folks. What are some intro amounts that you will take? 10,000, 50,000, and what do you do with it?
I mean, it's a matter of their cash flow and their resources, and what's right for them. I mean, it's for one person, it could be 5,000 or 10,000. For another person, it could be 100,000 or 500,000. It just all depends. As you see here with this chart that we have on the screen, it's not about just saying a specified amount. It's about looking at the totality of what they have and buying, something that integrates well with their overall strategy and is kind of, intellectually sound.
Very good. Well, we've actually hit the end of our time window here, so I definitely appreciate you guys taking some time here today. That was really quite good, I have to say.